I want to welcome you all today and thank you for taking some time to join a webinar about financial projections. I admit this is probably not the most exciting topic in the world, but thank you for joining us today. The first thing I want to do is set some context for the plan for today. So I'm going to be assuming that my audience for this webinar is mostly tech-related businesses. So I'm going to be focusing my examples and suggestions in some form of tech-related business. We'll focus on SaaS, marketplace businesses like an Airbnb model, hardware plus software businesses, fintech, direct-to-consumer brands, and mobile apps and that sort of thing, okay? So if you're starting a restaurant or a trucking business or an in-home healthcare agency, projections could be really important for you too. We just take a different approach for tech businesses than we do for kind of Main Street small businesses oftentimes. And so today I'm going to focus on technology-based businesses. Before I get too far into it, let me just introduce myself and provide a bit of background. My name's Adam Hoeksema. I'm the co-founder of ProjectionHub, which I started with my brother back in 2012. From 2010 through earlier this year, I served as the executive director of an SBA microlender in Indiana, and ProjectionHub was a side business for me. Today, ProjectionHub is my full-time effort and is a small team of three of us, Grace Cisna, our CPA and lead financial modeler, and then Kyle Fawcett, our director of marketing, and myself. A little bit about who we serve. Our business is really split between selling financial projection spreadsheet templates that we've built and customized for about 70 different industries, from SaaS to e-commerce to crypto and marketplace companies that are looking to raise investment, to more Main Street small businesses like trucking, restaurants, contractors, manufacturing, and everything in between. We serve these clients by providing customized spreadsheet templates, or we provide custom financial modeling services where Grace, our CPA, and I will help clients build out a custom model for their specific needs. Typically, our custom financial modeling leans a little bit more towards technology-based businesses. And for our clients that might be looking to get an SBA loan, usually one of our existing templates and video guides will do the trick, but we are here and available to support and answer questions. How long have we been doing this? We've been doing this for over a decade now. Grace has been leading our custom modeling work for a few years now as well. All right, so with that out of the way, why do we create projections? No one can know the future, and isn't it just kind of a pointless exercise anyway? Well, I think it's smart for an entrepreneur to create a set of projections before they start a business, but what I have learned over time is that I could kind of beat that drum all day that, maybe you should, run some numbers before you invest your life savings and just understand what it's going to take to break even or generate a profit. But you know what, it really doesn't matter. Even if we know it's a good idea to create projections before throwing our life savings into a new venture, most entrepreneurs will not create projections before starting their business. And I've just kind of come to accept this. And actually, I think it makes some sense, to be an entrepreneur, you got to be a little bit crazy and got to be willing to take some calculated risk. So anyway, that's not the reason that we create projections. Almost never do we create projections just for that internal planning. Mostly what we see is that the real reason to create projections is because the people with the money, the investors and the lenders, are asking for them. And so investors will ask for a financial model because they want to see how you plan to use their money, how long you think it's going to last, and what the potential return could be, right? Lenders will ask to see projections for startups or new projects or new divisions of a business because they want to see whether you think you can pay them back or not. And they want to see, things like your debt service coverage ratio, or unit economics, like how many cups of coffee is it going to take for you to sell to make your monthly loan payment, for example. So now that we kind of know that our audience here is the investors and lenders, that should really inform what we do next. So what is typically included in a standard set of financial projections? So when your investor or your lender says, "Hey, send me your projections," what does that mean, right? Well, for us, all of our templates at ProjectionHub include a 5-year integrated income statement, balance sheet, and cash flow model. Your investor might not require all 3 financial statements, but you can be pretty sure they're not going to require more beyond that. So that's a pretty good base. All right, so with some of that out of the way, the plan now is to spend most of our time walking through how to create a set of financial projections. And I'm going to use some of our templates as a guide to give us some structure as we walk through the process. My goal is not to teach you how to use our specific templates, but to show you the different components of creating projections, how to do good research and take a data-driven approach when modeling, and then some tools and resources that you can use to help you with research, and just kind of show you what my process is when I'm doing research, and then how to know whether your forecast is realistic once you're done. So once you've entered in all these assumptions, how do you know if what you've put together makes any sense? Or are you going to get laughed out of the room by the investor? So we're going to look at creating revenue projections. We're going to look at operating expenses, salaries, and then we're going to spend some time just looking at the end product, what that model is going to look like, and what the investors and lenders are probably really going to focus on and look at, so that you can be prepared for that. All right, so revenue projections. This is where we are going to camp out for a while, and I want to show you a few examples of different types of revenue models to show you the approach I take to creating revenue projections. As a quick aside, if you have an existing stable business with historical financials, then it's possible that the best approach for you is just to take last year's numbers and apply some reasonable assumptions or growth rates, or maybe contraction in spending, and based on your expectations for growth. Since that approach is quite straightforward, I am not going to spend any time on that today. We're going to focus more on a first principles approach. I'm going to outline two different approaches that I often take when building a financial model. First, a capacity-based approach, and then a customer funnel approach. And so these are, if we look at a capacity-based approach first, these are companies that are pretty certain to have demand for their product or services, and your revenue is really a function of your capacity. So probably the most obvious example of this would be a farm. If you think about a farm, it's a commodity, right? You're selling corn or soybeans, and you've got a customer at the end of the year for anything that you produce. Your revenue is really just a function of how many acres did you plant and what's the current price, per acre that you can generate for your corn and soybeans. And you really don't have to work at getting a customer. You don't have to build out a customer funnel. Trucking is another example where there's millions of trucks on the road. You can be pretty certain that if you have a valid driver's license, you have a working truck, you are going to be able to find work. It's just a matter of the price that you're willing to get paid for that work, and then the number of trucks that you have. That's going to set your capacity, and so based on those assumptions, you'll be able to calculate your revenue in a kind of a capacity-based approach. A daycare facility is another example, and the last example I have here of a capacity-based approach where your revenue is going to be dependent on the capacity of the facility, and that's dependent on probably your local regulations about how many staff members you need to have compared to the number of children at the facility. And so again, it's really just we know that there's a need and demand for daycare facilities, so it's really a matter of what price you can get and your capacity, the size of your facility. So I would say that most tech businesses do not fall into a capacity-based projection approach. So for tech companies, I typically use a customer funnel-based revenue projection approach. And these are companies where your customer might not even know your product or service exists. They might not know that they want it or need it. And so you're going to need to really go out and market well and sell. And so you'll likely have a customer funnel that has website visitors maybe, and they turn into leads, and those leads ultimately end up converting into customers over time. And so we're going to look at 4 different templates to just show you how we kind of think about that customer funnel and the different assumptions that could come into play. Now, your list of specific assumptions for your business is probably going to be different, but I'm going to give you some context here to help you think about how to build out your own customer funnel and your own set of assumptions, and then how to do research to find answers to those. All right, so bear with me while I pull up our first example. We're going to look at an e-commerce business here. All right, so the first thing here, we have this, again, customer funnel approach where we have visitor acquisition. We're acquiring visitors to our website, and we have got an advertising budget. So let's say we're spending $500 a month here to start out with, and we have a cost per click assumption. How much is it going to cost to get a visitor to our website? That's going to give us a number of visitors from paid advertising. We're also going to have organic visitors to the site, and that'll give us our total number of website visitors. From there, we have some assumption about conversion rate. What percentage of those website visitors convert into orders. And then from there, maybe we have an assumption about how many items that average order is. And we have assumptions about of those items that are purchased, what's the breakdown of, the price point and cost of goods sold and the relative popularity, like what percentage of your total sales fall into each different product category. And all of those assumptions are kind of going to be used to help us calculate our e-commerce sales revenue. All right, so it's kind of an example of that, the assumptions that build up to help us generate revenue. Let's look at our enterprise SaaS template. So say you're selling enterprise software, you might also have an ad budget where you're paying for ads, you have a cost per click, you might have some organic website visitors as well, and then some conversion rate of those visitors into customers. But if you're enterprise SaaS, you probably also have sales reps, and those sales reps, you might have some number of sales reps, and they can talk to some number of leads per month, sales rep leads per month, and they have a conversion rate there as well. And then maybe there's some other sources of customers, and there's also a churn rate, an annual churn rate. So this is what percentage of your customers are canceling each year. And from there, then we can get into, once we know our customers, we've kind of built out the customer funnel, then we can say, okay, what are they paying for? They're paying for setup fees and services, installation services, and they're paying for recurring revenue here for the software that they're buying. And that will ultimately help us calculate our revenue, right? All right, so I'm going to look at the mobile app model, very similar. The one thing I would mention is we have some different assumptions around what types of revenue. So we could have subscription revenue, maybe we have advertising revenue, we have in-app purchase revenue. And we have, if this is a consumer app, our churn rate may be very different than what a churn rate for an enterprise software tool would be. So that's something to consider. And we'll get into that in a minute. And then the last thing we'll look at is our two-sided marketplace. And the thing that's unique about this two-sided marketplace, like an Uber, for example, has drivers and riders. So the seller side on a two-sided marketplace, there's always a seller side and a buyer side. The seller side would be the drivers in the Uber example. So you've got to have a customer funnel to get drivers signed up on the platform. And then you need a customer funnel for riders to be set up to download the app and use the app and use it for rides, okay? And then what we need to do is we need assumptions that will help us match supply and demand. And this is an important thing because you can only sell the lesser of supply or demand in a two-sided marketplace. So for example, if we look down here, we've got this units purchase. And if we stick with our Uber example, if we're thinking about rides, when we sold 942 rides, that's how much demand we had. We had buyer demand of 942 units of buyer demand. We actually had seller supply. So the drivers were willing to drive 2,200 rides in a month, but we can only sell what we have demand for. Now, if this was flip-flop, let's say we had demand of 2,200 rides, but we only had drivers to supply 942 rides, we'd still only sell 942 rides. So just a kind of an extra complexity to be thinking about when modeling a two-sided marketplace. You want to get both of those customer funnels kind of modeled in there. All right, I'm going to take a second here, and I think while I'm in this file, and I probably should have done this first, but what I want to do here is just give you a quick view of what is the deliverable once you have done all this work. You're building out all these assumptions and models, and what do you get at the end of it? So we have this, all of our templates have an at a glance tab where you can look at a profit and loss at a glance. You get some key summary data, some key performance indicators like sellers and buyers and total marketplace revenue, employees and revenue per employee, get some key industry ratios and some graphs and charts and use of startup funds, kind of a break-even cash generated from operating activities chart here as well. Then you'll get a 5-year income statement summary, a 5-year cash flow summary, a 5-year balance sheet summary, and then an income statement, cash flow, and balance sheet report all broken down by month for each of the 5 years. So that's kind of the deliverable, and I just wanted to point that out while I was in the file. All right, so we are going to switch gears back to how we do research. And pull the slideshow back up again. Take a quick drink of water. Okay, so for a direct-to-consumer brand or e-commerce brand, as I was showing you those different files, those different models, you can see there are a whole bunch of assumptions. And the question is, how do we come up with reasonable numbers to put in for those assumptions? And so that's what I'm going to show you the approach I would take when I'm doing research to help you do that as well. So I'm going to go through each of the models and look at just a few examples, not every encompassing assumption, but a few examples. All right, so for revenue assumptions for a D2C brand, we've got cost per click for paid ads and organic website visitors. Now, both of these I would use some third-party tools, Google AdWords Keyword Planner and Ahrefs. And I'm going to show you those, but I'm going to do that at the end here. I'm going to first look at everything all the assumptions that we can answer with a simple Google search. That's what we want to do first, because those are easier to document and for you, right? So conversion rate of website visitor to an order and average order value, we can do some simple Google searches. So I'm going to show you what I would do. If I had an e-commerce brand, I would just say e-commerce conversion rate, and lo and behold, we've got Google gives us a great, in bold highlighted numbers here around 2.5% to 3%. So that gives you a good range, a good starting point. Now, you'd probably be able to dig in to conversion rates based on the type of thing that you're selling, your industry, and maybe even find even more specific data. But you can get a really good starting point here, and I think that's important to have some frame of reference, because a lot of times what I'll see is, people that don't have any context, they think, seems like we should be able to convert 10% of our customers, or 10% of our website visitors into customers. We've got a really great product, and they don't understand that it doesn't matter how great your product is. Even Amazon, the best e-commerce juggernaut, right, would probably have a 2.5% to 3% conversion rate. That's just, that's just an industry expectation. Do a quick Google search for average e-commerce order value, and you can find, this was like the first result I found, had a nice graph with some data and numbers. You can see the COVID dip there. So I think, again, just doing a quick Google search for a lot of this is going to be really helpful. All right, so for a mobile app, all 4 of these assumptions we can actually do with the Google search. So conversion rate, we're going to look at conversion rate of lead to download. And this is kind of interesting. So there's a couple things, and you'll need to know the specifics of what data you're looking at, because it could really matter. And this will be a good example. So here we see that the average conversion rate across categories is 31% in the App Store, 33% in Google Play. So what exactly does that mean? What this particular assumption means is that if a visitor gets to your app's page in the App Store, then the conversion rate is 31 to 33%. But if somebody is just doing, let's say you have a flashlight app, and somebody goes to the App Store and says flashlight, and your app shows up among 6 other different or 50 other flashlight apps, in that case, you have just a 4% conversion rate. So, you need to know this now. If you're thinking about, like, you might have some data on how many people are searching for flashlight apps somehow. Maybe you got that from some source, and you want to know, okay, if we can be one of the results that shows up, what do we expect our conversion rate to be? Well, it's not going to be 31 or 33%. It's going to be 4% is what this is saying. And so you don't want to accidentally use the wrong conversion rate for the wrong assumption, right? All right, so let's keep on going. So average churn rate for consumer apps. So this is important, and we'll look at the B2B enterprise SaaS model. The conversion rate is going to be way different, or the churn rate is going to be way different. But this is crazy for the average app user churn over 3 months is 72%. That means that you do all that hard work to get those 4% of people that downloaded your flashlight app after a search. 72% of those 4% are not going to use the app again after 3 months. They're going to churn out. And so you can, again, you could make a major mistake by taking the enterprise SaaS churn rate, which we'll look at in a minute, is in the single digits, and using that for your consumer app, and just have radically outlandish projections because you're not picking the right assumption for exactly what you're doing. All right, so another thing that I really like to do, people will send me their mobile app projections or their mobile or web app projections and say, how do you think they look? And I will look at the average revenue per user per year, and I'll compare that to Meta or Facebook. And because there's some really good data here, I can see the average revenue per user and see that, wow, you're projecting 3 times more revenue per user than Facebook, who's probably the best at monetizing users. So I think that that's a big red flag, and that's going to be pointed out to investors. They're gonna catch that kind of stuff. So as you're thinking about how much do I think I could sell in-app purchases or advertising per user, this is a good thing to search for to see examples of what other companies are doing. Particularly Facebook is a good example. And then if you're trying to figure out, hey, what could my average spend per user for in-app purchases? Again, just a simple Google search, right? It's going to tell us exactly what we need. All right, so B2B SaaS, we can do Google searches for these as well. We wanted to know how many leads, we had that assumption about sales reps, and then how many leads a sales rep could handle per month. Now, again, the definition of things can throw you off and make a big problem in your model. And so I looked at Quora. I found this rule of thumb here is 400 leads a month per rep can be handled effectively. Okay, well, in my model, I had like 20 leads per month. But the question is, what is really considered a lead? And so the language that you're using is a big difference. So this gives a great example of that. And this really actually shows a kind of a customer funnel. And you might, in fact, want to use these ratios as a good source. But you can see, okay, if we have a website visitor, so let's say we know we are going to have to pay $1 to get a website visitor. We know that 2.3% are going to be leads, what they're calling leads. Then of that 2.3%, 37% will become a marketing qualified lead, 32% a sales qualified lead, 40% an opportunity, and then 46% of those will close into becoming customers. What I was doing in that model, I was probably calling a sales rep lead being like either the SQL or the opportunity. So I don't think, one sales rep can't handle 400 opportunities per month, but maybe they can handle 400 leads because we're going to chop these down so much at each level, right? And then the churn rate is one thing. I just wanted to, again, give you an example of why it's really important to know the churn rates and no assumptions for as specific of a business as you have as you can find. So I wanted to know what's the annual churn rate for B2B SaaS, not just what's the annual churn rate for any old business, because for a mobile app, we saw 70-something%. For B2B SaaS, 3 to 7%, 1 to 2% for larger companies. All right, so now we have our D2C brand and our marketplace, where I'm going to look at some third-party tools and show you how I use them to do kind of more sleuthing around and get some more information. So we're going to pretend that we sell a coffee maker, and we're going to go to the Google Keyword Planner. And what I go to is tools and settings. So Google Keyword Planner is free, but you have to set up a Google Ads account first. And then you'll come to Keyword Planner here, and then do Get Search. I need to reload this page. Let me just try to reload this so that it can get that out of the way. Okay, so then you'll come to Get Search Volume Forecast, and let's say we're going to look for coffee maker because we're trying to sell a high-end coffee maker. And then the other thing I always do is I want to get all available data. So you get to be able to see the trends of like when people are searching for coffee makers. And down here in the keyword, you'll see coffee maker gets an average monthly searches of 201,000 on Google. And the top of page bid, the low range, is 41 cents per click of what advertisers are paying for the word coffee maker, and $1.45 for the high range. So you can get a good idea of, okay, maybe it's going to cost us about $1 per click. And so that's an assumption that we wanted to try to find out, right? And then we wanted to know organic website visitors. So how many organic website visitors might we be able to get? What I like to use is a tool called Ahrefs, and this is a premium tool. You do have to pay for it. I think you can do a free trial probably, so you might be able to do your research during a free trial period. But I would come to this Keywords Explorer and I would look up coffee maker. And the thing I wanted to point out here is that if we come down here, we can see the top results, okay, for that keyword. And we see Target. Target's the top result here. Amazon's the second result. So let's just copy this link address. So copy this Amazon link. We want to see now, we want to see how much organic traffic is one of our competitors that's ranking second for that keyword. How much traffic are they actually getting to that page? So we come over to Site Explorer and paste in that link, maybe. And now Ahrefs is going to give us a whole bunch of information about how much organic traffic they get. And we can see, this range. This is kind of the reason this is so bumpy here is probably them moving from like first position to second position to third to back to second to first. And so, but we can see kind of a high end 46,000 visits to that page per month, down to maybe a low in the 6,000-7,000 range. So what I would do is, if you have a competitor if you're building an app of some sort and you have a competitor that has a similar app, put their website in Ahrefs and you can see how much organic traffic they have. And let's say they've got a 3-year head start on you. You can actually look back at like all-time organic traffic for that page and get an idea. We could look at monthly traffic. Yeah, so this gives you an idea of like over time, how much traffic did that page have in terms of organic per month. So if you do that with your competitor, you should be able to say, you'll know like, hey, we're probably not going to out of the gate get more organic traffic than our competitor who is ranking first for the keyword that we want to rank for. So this gives you some context of what's probably the right amount of organic traffic that you might be able to get, and maybe over time, like how long do you think it'll take you to get there? Now, we see the Amazon example, they kind of jump straight up, and they're Amazon. So that's probably why it would probably take you longer. It'd be the slow roll probably, but gives you an example. Okay. We're going to look at marketplace example. I want to show you just an idea of how to kind of get an idea if you're building a marketplace, how to get an idea of the buyer demand versus seller demand. Okay, I'm going to go back to Ahrefs here, and we'll go to Keyword Explorer. And let's say we are going to build an NFT marketplace. And so our customers would be people selling NFTs or buying NFTs. And so they would be searching for how to buy an NFT. And so you'd be able to see how much search volume that gets in a month, 7,300 for how to buy an NFT. And if you want to get an idea of how many people are searching for how to sell an NFT, 3,800. And so you get some idea of like, what's it going to be? Is it going to be harder to find buyers or sellers based on search volume? Gives you some context there. All right. So we're going to jump back over to one of our models. We're going to look at the B2B SaaS and look at expenses. Okay, so for our expenses, we have this input other expense category or tab in all of our models. And just to give you an idea of the different ways that you might want to build out your expenses, they're probably either a fixed dollar amount, a percentage of revenue, or a per FTE, full-time equivalent employee expense. And so the way I've got this set up and what I commonly will recommend to clients is that for that, if you're trying to raise investment, you probably have some idea of how you want to spend that money for the first 12, 18, 24 months. And so you'll want to put in probably monthly kind of specific expenses, dollar amounts that you expect to spend on specific expenses, maybe for the first year at least, right? But then after that line of sight is kind of passed and you don't really know, kind of what you spend kind of depends on how well the business is doing. Then what you might want to do is kind of transition to a percentage of revenue approach and just say, hey, we're going to spend 12% of revenue on general and admin. We're going to spend 15% of revenue on software development and 15% on sales and marketing. So I think, you could do some research on your particular type of industry and find these ratios, average ratios of what, other B2B SaaS or what other mobile apps are spending on research and development or general and admin. You could look up publicly traded companies that are in your type of industry and look at their financial statements and see what they're spending on a percentage of revenue basis to give some context there. And then on the salary side, you can do simple Google searches for the different titles. What's a developer making? What's a CTO making? What's a CEO? What's a director of marketing? Whatever different titles that you might have. You can also, in our model, we allow you to put a month ending. So let's say we wanted to say, okay, this is what we're paying, but these are just for the first 12 months. We're going to set these all to the first 12 months. And then after 12 months, we're going to transition all of these people to basically just fall within these buckets. So some of our staff are going to fall within software development, some in the sales and marketing budget, and so on. So you could take that approach. All right, and so then that brings us all the way back to our at a glance tab. Now, the thing I want to point out to you here is, what are the investors and lenders going to be looking at? What I typically look at is this at a glance tab, and I'll look at what are people projecting in terms of percentages, so gross profit and net income percentages, and how do those compare to what I'm finding in the industry? So if, for example, if you're projecting a net income percentage of 65% and you find out that Google's net income percentage is, 30%, then something's probably off. You can also take a look at these different KPIs. Look at, they're going to look at, your monthly revenue per user, make sure those seem in line with the industry. Monthly revenue per employee, annual revenue per employee is something that people might want to look at and just make sure that kind of falls within what others are doing and what they've seen and what they might expect. The last thing I point out here is that you want to make sure that if you're looking to raise money, the expectation is that you would spend that money and you would lose some money probably in the first year, right? You're not probably going to generate 19% net income in the first year. So I'd look at what we've got entered in here right now and say, hey, this probably doesn't make sense. Why do you need to raise any money if you're profitable? So I would expect you to show a loss for the first year or two. When you're using that investor money, that's what I would expect. So I want to give you just a couple more resources that you can use, and I'll send these out in an email, these links out in an email. But we did a partnership with Story Pitch Decks and kind of pooled together some of our data to see what other startups were projecting, what were they forecasting in their first year of revenue. And so this is not to say that these numbers are what they actually did, what they actually generated in revenue. This was just, we looked at 102 different pitch decks and financial models, and in pre-seed, seed, Series A rounds, different industries, so B2B, B2C, software, direct-to-consumer, and marketplace businesses. And then we looked at how much revenue they projected in their first year based on the industry and the stage of the business, okay? Yeah, I think that can be insightful to you, just to see that, you want to make sure that what you're showing a investor is not way out of line with what they're used to seeing. And this study kind of gives you an idea of like what they might be used to seeing based on what others have, what others are projecting, right? And then the last thing I'll say, and I'll send you a link to this as well, at ProjectionHub, we studied 234 different tech startups in those same categories: B2B, B2C SaaS, direct-to-consumer products, and marketplace startups. And we found some key insights like average revenue by business type, by stage. So this is actual revenue that's reported from these private companies. We get average revenue per employee by different industry type, by stage of business, whether they're bootstrapped or raised investment. We can see different things. So again, I'll send you this link, but I would, once you're done with your projections, kind of go look at these studies and look through the lens of those studies to say, hey, do these assumptions, does our model make some sense based on what others are doing? So, all right, I think I'm going to stop there. And I don't know if we haven't answered any questions that you still have. I just want to invite you to email us at support@projectionhub.com, and hope that you will reach out and just ask additional questions, and we'd love to be able to try to help point in the right direction. And we showed you some of our templates in the webinar. We do have templates available for sale, so you can, if you want to save some time and not try to build your own model from scratch, we probably have a model that's a good fit for you. It's a starting place, and so you can go grab one of those. And if you need any help customizing it, we are here to do that as well. So with that, thank you for your time today, and look forward to hearing from you.